how to purchase and finance distressed multifamily properties. I'm Jason Jaken, owner of Jaken Finance, and in this video, we're going to talk about the most efficient or most economically feasible ways to purchase distressed multifamily properties. But before we get into that, if you have any questions related to financing, go ahead and find my number below or reach out to us at www.jakenfinancegroup.com. That link is in the description below. So I've seen a few people ask this question, and it's been a topic for many years, but I don't really see anyone explaining it to new borrowers, and therefore it leaves, I think, an untapped, there's an untapped well of people who would benefit from this information. So I recently, I think it was October, November last year, I helped an investor who's local to me acquire an 8-unit property, and they bought it distressed. And it wasn't so much distressed than that there was a lot of rehab that was needed, but the rents were very low. So if you were to go to a DSCR lender or a debt service coverage ratio lender to look for a loan based on the rental amount, you would get hammered with the leverage because it's not stabilized, meaning the rents aren't at fair market value. And so instead of putting your typical 20% down, you're going to put maybe 30, maybe 40, whatever would allow the income of the property to cover the expenses of the property, meaning your principal, interest, taxes, and insurance. So what do you do? Well, what you can do is go to the property, take a look at if there's some rehab that can be done, and also take a look at what your fair market rent needs to be. And you can go in with what's called a bridge loan. You can also call it a rehab loan, but really you just need a loan that doesn't look at DSCR, that ratio. And it's a short-term, 12, 18, 24-month loan that will allow you to acquire it, fix it up not only conditionally, but with the rent number. So if that means raising rents on tenants, potentially kicking some tenants out, whatever that looks like, you can do that in that short-term interest-only loan, that bridge loan, and then typically 6 months later, refinance out using that ARV and those new rent numbers. Now, if you anticipate that takes longer, which it could in some markets that have like rent control and tenant protections, like in Chicago, for instance, there are some tenant protection rules and rules that need to be complied with. Those may take a little longer. You just talk to us and we can extend that term out to ensure that you get the property stabilized so that you can get into a long-term loan, a 30-year fixed, ideally with the correct numbers. If you try to do that up front, you're going to find yourself putting a large down payment in, and then you're barely going to cash flow because those numbers are so low. So that doesn't make a lot of sense. So bridge loan first, refinance into a DSCR loan. The other option, which doesn't really involve a lender, but I'll just tell you about it anyway, is try to acquire the property with owner finance. That would also be somewhat of a bridge type loan, interest only with a balloon. You could probably make the term longer depending on the motivation of the seller. The seller carries a note, and this doesn't really work a lot of times when the seller also has a mortgage, but if the seller owns a property free and clear and they're just trying to get rid of it, but you need to fix it up and you need to get the rent stabilized so that you can be in a healthy mortgage, you would propose a seller finance deal. They carry the mortgage, you pay them monthly interest only payments. There's a balloon at a certain time in the future, 2, 3, 5 years, whatever. And between then and the balloon, you would fix it up, refinance out, and then you're in a healthy long-term mortgage, fixed interest. So that's how you should do it. I've seen this question a lot. I hope it helps. If you have any other questions, my number is below, and so is the website. See you soon. Peace.